You guys are in for a treat. Simpreet, Kevin, and Barry are all wonderful human beings that I've only recently had the pleasure to get to know, but they know their stuff and they're excited to share that with you. I mean, during the kind of preamble before we got into this, we were all kind of reflecting on the types of questions that you guys were asking, and we're genuinely impressed that these were not the types of questions that we were asking at that age. So you're already a step ahead of the game, and it's going to put you in a good position when it comes to money. Getting a head start is not the worst idea. So guys, my name is Damien. For those of you who don't recognize this face or this voice, I'm with the team at My Blueprint, and I'm very privileged to have the opportunity to be able to organize an event like this. For those of you who are curious, we've been doing these about once a month for this past school year. We reached out to our partners at the start of the school year. So all the school boards who are licensing My Blueprint to use with their students to help them to make more informed decisions. We reached out to them and said, hey guys, we know that this year is going to be a school year unlike any other. We know that your priorities have shifted, and we know that My Blueprint not going to be your number one priority. What are your priorities though? Because we want to help you with those. We want to support you with those. And they came back with a whole bunch of amazing things they needed help with. They said, well, our students are behind screens, they're behind masks, so we need help with motivation. How are they going to take your kids to work day? How are they going to volunteer? How are they going to make more informed financial decisions? So we've been reaching out to experts across the country to organize events and opportunities like this to help answer those questions for you and for your students. We've added all of the recordings to our YouTube channel, which I'm going to mention now actually because there were a lot of questions specifically about like how to apply for OSAP or how to apply for scholarships. That's not exactly what we're going to be covering today. We will cover a lot, but I'm going to highly encourage you to check out our YouTube channel. We have two really great webinars that tackle those topics specifically. One with Janet of My Campus GPS, all about scholarships, how to find them and win them. And then one with Suzanne Tyson about all the ways to pay for school in addition to scholarships. We're going to talk about a few other things not related to scholarships. And I should mention also that there were a lot of specific questions about the specific types of stocks to buy. We can't give you that information, right? This information is today's for informational purposes only. Can't tell you what stocks to buy. That's a whole legal mess. On top of that, I want to quickly highlight this nice banner in the back. So for those of you who don't know My Blueprint, we started a podcast a few months ago to highlight some of the things that industry are looking for from young people when building out their 21st century teams. So what are these 21st century competencies that they're looking for? There's actually an amazing episode from Jenna from Scotiabank who talks about how they hire students and what they look for when they're hiring students. And Scotiabank does a lot of hiring with young people. So I think it's episode 14 of season 1 with Jenna Camasoli. I would highly recommend checking that out. And then the other thing I mentioned, I did talk about the fact that we're not going to give you specific stocks to buy, that information, but there is a webinar coming up in July with iTrade, which is part of the Scotiabank family. That is information that you want to talk to those experts about specifically. So Barry's back. Kevin's going to be here any second. Let's jump into it. I've done enough talking for now. Simpreet, just to help some of the students and educators who are here today learn a bit more and kind of relate to you guys, big part of My Blueprint is helping students kind of make more informed decisions about life after high school. And a lot of these students are considering their pathway. What should I do? What opportunities are available to me after grade 12? Simpreet, you're a branch manager now, correct, with Scotiabank? Mm-hmm. Can you talk a little bit about your pathway from 18 years old to branch manager?
Sure, absolutely. I mean, firstly, kudos to you guys and the whole Blueprint team. I mean, I wish I had a platform like this when I was in grade 12 and kind of trying to figure out what to do from there onwards. From the age of 18, I went off to university. I attended Wilfrid Laurier in Waterloo. So I did live on campus and then, off campus there. But, my parents lived in Mississauga, so it was somewhat of a commute. And I did a program there in business and economics and graduated and then started off a career with Scotiabank. So right after graduating from university, I did work a part-time job all throughout university at a men's clothing store. And so worked there for the summer after graduating and was applying to all sorts of, companies trying to get a job. And I had reached out to a branch manager and just said, I really want to figure out banking. I want to see what what else is out there, what opportunities are out there, what are you looking for in candidates when you're hiring. And they were fortunate to then, have a meeting in place, and they said, okay, what's the experience like, and just kind of set the expectations that they had for a role of a financial advisor. And that's how I started my journey with Scotiabank as a financial advisor. It's a very, very noble profession in my opinion. You are constantly helping people. You're meeting all sorts of people on a daily basis, all have different, goals, all have different concepts in terms of what keeps them up at night. And it's a very, very noble profession to be helping people throughout their journey. So that's me.
Okay, thanks very much for that. And it was really cool to hear you mention that you kind of worked throughout your undergraduate degree. That was a question that came up a few times about how to balance that. So I'm sure we'll come back to that. And one thing I took away from that was you taking the initiative to reach out to the branch managers and to figure out what kind of opportunities were available. And you found financial advisor, and I'm sure lots of opportunities. Scotiabank is often, from what I've learned, able to provide people a whole bunch of different opportunities just because of the size of the company. And now you found yourself a branch manager. So super cool. Barry, let's switch it over to you. So we're just getting to know our panelists a little bit real quick. What was your favorite class in high school growing up?
I really enjoyed geography. I've always enjoyed different parts of the world, different cultures, different experiences. And geography was one of those things that kind of brought it all to the forefront for me. Yeah. So certainly a class that I enjoyed, certainly something that I took on in life, and I, try to travel as much as I can. Obviously COVID's put a little bit of a pause on that, but when things return to normal, it's something that I hope to resume and something that I took a lot of interest in. Absolutely.
Yeah, it's one of my favorite classes too. Cool. Yeah. Kevin, take us home. I'm a young person listening to this. I'm interested in working in the world of finance. What kind of advice do you have for me post high school if I wanted to potentially see what options are available?
I'd say just, ask lots of questions, get your name out there and meet as many people as you can, try and network, try and get yourself in front of as many people who can help you. Like Simpreet's experience was getting in front of a branch manager at a very early age. Bankers by nature, we're here because we like to help people, right? Be it with their finances, be it with their lives. We're here because we enjoy helping people in any way we can. And if you get in contact with us, we'll do everything we can to put you, if we're not the right person that you want to meet with, we'll try and get you in contact with it. But just by being proactive, putting yourself out there, like half of the, the life skills that I've learned by working with the bank is just by, stretching myself out of my comfort zone and not being afraid to put myself out there and asking for opportunities. It's always paid off. Like you'll never find with us, you'll never find someone that's not willing to help you.
Yeah, super cool. And I mentioned at the very start, but for anyone who's just come into this webinar now, Competencies Without a Classroom, Season 1, Episode 14 with Jenna Camisoli. She's part of the team at Scotiabank who hires young people right out of school. She's got some amazing advice to kind of build off what we've already talked about so far about that relationship piece. One of the most interesting things I took away from that conversation, I think it was a new initiative within her department this year, but they actually don't even look at resumes. Right? So their big thing in her department is the relationship piece. They're looking for students who over the course of their education and post-secondary journey have taken the initiative to learn about Scotiabank, to get involved, to join clubs, to attend events, all the types of things that allow you to show your initiative, allow you to show that you're so much more than just what's on that 8.5 by 11 piece of paper. So definitely a good episode to check out for all the young people listening today. Now let's get into the questions. You guys submitted some really, really great questions, and I've collected a bunch of them. So if you see me looking off to the right, that's just because I'm looking at the questions. But I want to encourage this group today to continue asking questions. And for the panelists, what we're going to do is, we're going to try to take out one at a time. So we'll go one question per person. But if you want to build off anything that your colleagues have said, jump right in. This is an Ask Me Anything fireside style type of chat. This is the last question that I'm going to ask all three at the same time because it's an interesting question and something we're putting together after this as well with some other people from Scotiabank. But so Barry, what's one of the bigger regrets you have related to money about being younger and not having the information that we're providing to these young people today? Like what's one of your bigger financial whoopsies?
Yeah, it's a great question. And it's certainly something that I can think back to. I think when I was 18, one of the first things that I was offered at the time I was doing my banking was CIBC. And I had a job and was earning a little bit of income. And I just happened to be doing my banking one day. And one of the tellers had said, "Hey, do you have a credit card?" you know, like anybody interested in having access to money, I jumped on the opportunity to get a credit card. It was a $500 credit card, and I think I was pretty quick to max out the limit on that, because at the time my vision of how I needed to manage money was very narrow, and I perceived the credit card to be free money and didn't really think about the necessity of paying it back, how I was going to manage my own cash flow, what I was doing with the money that I was earning, and managing it in appropriate capacity. Needless to say, I screwed up, you know, and really didn't kind of manage my credit in a way that certainly I would think is responsible. The nice part of it was that I was young, and it was only a $500 limit, and I was able to repair and rectify that pretty quickly. And I think, you know, looking back at it now, if I could coach myself as an 18-year-old to say how to be responsible about spending and managing money, I'd say, look, you know, credit is a huge thing. It's the gateway to a lot of life's future opportunities, and managing it appropriately from day one, making sure that you have a budget, stay within that budget, and don't spend beyond your means is one of my initial regrets, but something that I've been able to grow and evolve at over the years. So yeah.
Yeah. No, that's a fantastic realization, and you're not alone in that. There's a lot of people who were given a credit card at 18 and thought it was just magic money, right? So we're going to come back to the credit, building credit piece a little bit later, because that was a question that came up a few times. But I want to dig deeper, because I remember when I was given my first credit card, probably 18 years old, just started my undergraduate at the University of Guelph. Again, thought it was magic money. And maybe I was told this and wasn't listening, or just wasn't communicated well. But Barry, can you explain in simple terms, how do you pay back a credit card? Like, how do you pay back the money? Do you have to pay it back all at once? Or like, what if I don't have all the $500 in my debit account to pay back in my credit card? Like, how does that work?
Yeah, so certainly would encourage people to pay back, you know, as much as possible, right? Like carrying balances, holding over balances, that allows interest to accumulate and compound. And I think that, you know, reasonability would say, hey, let's try and pay this off with the best frequency possible. But certainly making payments on time, you know, monthly statements are received. I know we're in a world now where everything's at a glance on your phone or on your laptop or whatever it may be, or your tablet for that matter. And I think, you know, just really being mindful of the due dates in which payments are due, making sure that you pay in advance of those due dates, and staying routine about that, not missing payments, and really staying up to task, right?
Yeah. That's a great answer. And something you mentioned as well is spending within your means, right? So if you know you're not going to have the money to pay this thing back, then it may not be the best decision to make. Obviously, emergencies happen, and credit cards can be very helpful in those situations, but spending and living within your means is going to set you up for success for a long time to come. Right?
Absolutely.
Simpreet, so let's ask you that question. What's a financial mistake or regret that you've made?
So mine's actually pretty much the opposite of Barry.
Oh, wow.
So both my parents are, first generation in Canada, so they're immigrants. So growing up, it was, you don't spend money you don't have, you want something, did you save for it? No, you didn't. Too bad you're not getting it. So
Right.
I actually got my first credit card, believe it or not, when I started working with Scotiabank. Before that, it was like something like, I don't know why, like the fear in me was like, oh my God, if I sign up for a credit card, I'm going to be in so much debt. I'm not going to be able to pay it off. And so thankfully, I'm glad, like I took the time to educate myself on exactly what you just covered, how to pay it off. Am I comfortable with, a certain limit? Do I know that I'm going to be able to sustain this? And the reason why it was a regret is because by the time I came to a position where I was looking to first, buy my first home with my husband, guess who didn't have a sufficient credit history, right? So that 100% was my biggest regret. I think the fact that I think all banks offer credit cards, to students for them to establish their credit. They do that for a reason, because it's extremely important to make sure that you're showing those behaviors of being able to manage credit at a young age, and it builds history, So if you have the opportunity to do that at the age of 18, well, guess what? At the age of 28, that's 10 years worth of a credit history that you've established for yourself. And that can go a long way when it comes to, leveraging any sort of like mortgage loans or whatever it may be to accomplish your goals.
That's super interesting. Yeah. And probably super relatable for a bunch of people watching this as well. Let's drill down a little bit on that. So just want to put it in language that I think I would understand as like a 16-year-old watching this, right? So, because there were a lot of questions about why do I have to build credit? Like, what does that even mean? And I think the example you just gave kind of illustrates it pretty well. And correct me if I'm wrong, but can I simplify it enough to say that it's important to build credit so that the financial institution, like the bank, can know that you're trustworthy. So is it that you're building trust with them over time so that when you do need that larger amount of money for that house, as an example, they've seen over the years that you are the kind of person who spends money but pays it back and pays it back on time and pays back the interest? Is that generally the idea of why it's a good idea to build your credit history early?
That's 100% bang on. That's 100%. So absolutely, it's basically showing, it captures, right, like your behaviors when it comes to credit and how diligent you are in making sure that your payments are made, whether it's a minimum payment on a monthly basis, whether it's not maxing out your credit card, right, all in one go, or keeping it maxed out for a long period of time. But all those little things add up, right, and that overall illustrates what your credit history is comprised of.
Yeah. Okay, that's awesome. Kevin, your turn. Do you have a financial mistake, something you made when you were a little bit younger that might be different than what Simpreet and Barry have already talked about?
Where do I start? The one that sticks out for me the most, honestly, is, so I was lucky enough, I worked for the bank all the way through undergrad. So I had already built a bit of seniority by the time I finished school, and I went into a management training program right afterwards. So I was, for my age, I was making, pretty good money compared to my peer group. And I was like, oh, okay, let's buy a car. So at a fairly young age, I bought a car, and I didn't really fully understand all the associated expenses with insurance, maintenance, and all that stuff. And for a long period of time, it was a really big millstone around my neck. So while it's like sometimes you look at something and think, oh, I can afford this based on my cash flow, based on what I make. When you don't necessarily think about what other things are coming during that time period and what other expenses you might want to take on, say it's buying a house, renting an apartment, or something like that, it really might impair your ability to do something later down. So there's the immediate benefit of having a really sweet ride and your friends could all come hang out with you, and the later on benefit of not being able to do some of the things that you'd like to do.
Yep, that makes a lot of sense. And so actually, speaking of that, is there a resource that you can recommend, whether it's something Scotiabank has created or provided, that would allow students to do this kind of budgeting activity to see if it does make sense to buy the flashy car or not?
Yeah, I think there's a calculator online. If you go to scotiabank.com, there's plenty of resources on there that you can click around.
I know I've come to find scotiabank.com/students actually has a fair number of helpful resources in there as well. But yes, definitely a good learning moment, especially when we're all younger. We all want the big, expensive, fun thing. We finally started to make some money. For me, I'm going to share mine. I'm just thinking of it now. So I got my first job. It was whatever the legal working age is in Ontario. I can't remember if it was 13 or 14, but my mom, I still remember it vividly, growing up in Newmarket, Ontario, in Yonge Street. It's this really big street that runs through Ontario all the way from Toronto up north. And we printed off a bunch of resumes, and she put me on Yonge Street, and she basically said, don't come home until you have a job. Paraphrasing, but it was very much like that. It was a great experience. Obviously, I learned a lot from working from a young age, but kind of like Kevin was just talking about, with my peers, I was making money at 13 to 14, and a lot of them weren't. So I had all this money, but I was buying the flashy things, right? And I was buying the group dinners just because, I wanted to pay it forward and help out the friends. But if I had managed my money a little bit more appropriately, the little bit I was even making at 14 could go a long way. So actually, that's a good segue. Let's go, Barry. Barry, what is compound interest? And why is it so important for a young person watching this to understand what compound interest is?
Yeah, compound interest is just money growing on itself, right? So the longer that you leave money invested for, it continues to accumulate. And so I'll call it snowball, right? Yeah. And so the beauty in money snowballing is that you get progression in what you initially invested growing more and more. And so anytime that you can leave money invested for a significant period of time and you can allow it to grow and magnify its growth by letting it grow upon itself, is a real opportunity to see your money expand for yourself and obviously cater towards future goals and things like that.
Okay, that sounds great, but I'm gonna drill a little bit deeper. So Simpreet, we'll go to you. How do I make my money grow, right? Like if I'm getting a paycheck from working at McDonald's, do I just put it in my checking account? Will it grow, or like what do I do?
So there's many different options, and firstly, like the concept of saving in itself is important, right? It's not how much you make, it's how much you keep. There's people out there that make $100,000, but they blow the paycheck, all in one go, right? And then there's people that make $1,000 a month, or like $12,000 a year. But if they're saving 800 of that 1,000, then that goes a long way. So there are, there's a lot of different, I guess you can call them streams to kind of start your savings. There's typical savings accounts where you can park your money and make sure that it's kind of set aside for emergency savings. And then you get into a little bit more complex saving approaches, which are registered accounts, right? So you've got a tax-free savings account. If you're 18 years of age or older, you can set up what's called a tax-free savings account for yourself and set up what's called pre-authorized contributions. So if you know you're getting paid, let's say it's direct deposit, comes into your account every other week on a Wednesday, you can actually, through the bank, set up an automatic transfer for, let's say, a portion of that paycheck to go directly into savings. And then it's interesting, you see it start building, you can start seeing that, like, the money accumulating. And it's important to make sure that you're having the right conversation, whether it's with the financial advisor or whether you do the research on your own and determine what your comfort level is to understand what to do once that saving starts to build. So then it goes into that compounding, that snowball.
Yeah, it's a beautiful thing. And so we're going to go into kind of TFSAs, and there was a few questions about kind of what are those and what's the difference between a GIC and RRSP. But you touched on one thing that I want to drill down a little bit more on, Simpreet, which was a portion of your paycheck can go here and there. And I'm sure it's a complex answer depending on the client and the individual you're working with and what their goals are. But let's imagine, again, I'm a 16-year-old, 18-year-old watching this right now. I want to go to post-secondary. Maybe eventually I want to buy a house. What would you recommend I do with my money? So if I get a $1,000 paycheck every month, where should I split that up?
So, I mean, firstly, of course, it's important to understand your budgeting, right? If you're paying your own phone bill, if you're paying, let's say, like you're helping her out around the house and you're paying, you're helping your parents out and stuff like that with some bills because you're now working, those are things that you obviously want to consider. What are your fixed expenses? What are things that you're going to need this money for? Because the last thing you want to do is start saving money, but then having to go back into those savings and just kind of, draw from them again. And you're not necessarily all that disciplined in your savings approach, right? But I mean, it's that number in terms of how much of a percentage of your paycheck is allocated to savings is gonna differ for each and every person.
Right.
So I would say start with what you're comfortable with, but by identifying what your goals are. So if your goals are to buy that car after you graduate, if your goal is to save up enough money for a down payment, just make sure that you have a number associated with that goal, so you know how much you put aside for that goal to be achieved, right? Every time let's say you set aside $500 and bi-weekly, once you see that money gradually grow, it makes you want to save even more, because that you see that you're reaping the benefits of that, that disciplined savings approach.
Yeah.
And just to jump in, this doesn't change when you become an adult. It's the discipline that you learn, and the earlier that you learn it, this activity is going to continually repeat itself as you get older and older, because it's just the things that you want probably get a little bit more expensive every time, right? But to learn this at an early age is so invaluable, right? To learn the discipline
100%.
of, okay, well, what do I need to do? What's my end goal? And then work backwards from there. The earlier you get used to this activity, the earlier you get used to thinking about, it's just a math problem, right? I need to get to X, and there's several ways to bridge from where I am now to X, right? And you can choose any one of these pathways based on what you prefer, what your tolerances are, right? And it's not going to change. When you get older, it's the same thing, right? I need to get to X, I need to buy that house, or I need to upgrade my house. And there's several different ways for me to get there. It's what am I capable of? Where am I going to be willing to sacrifice to get to this goal sooner or later? And how am I going to get there? And what help do I need? What advice do I need to get there?
Yeah, 100%. I was going to say almost the same thing. I can't, for all the young people listening, I cannot recommend the auto transfers highly enough. I was stubborn at first. I don't need to set that up. I'll remember to put it in. You won't. And if you do automatically set it up, like Simpreet said, it's contagious. And Kevin said, it's like you see the money building, you want to keep adding to it because you get that much closer to the goal, right? Kevin, let's stick with you on this one. And we started talking about it, but what are all these acronyms? So let's focus on three. There's a TFSA, there's an RRSP, and there's a GIC. Maybe we'll do one at a time. So Kevin, you take TFSA.
TFSA is a tax-free savings account. So there's different tax management strategies. Tax-free would be the best, well, not the best one, but the simplest one in that this is post-tax income or post-tax funds that you're putting into account. There's a certain amount of contribution room that you're allowed on an annual basis. And the way a tax-free savings account works is whatever you contribute to the account, you can place into an investment vehicle. It could be in, it could be stocks, it could be GICs, it could be various range of things. Whatever return you earn in that account is not taxed. So you've got quite a bit of growth potential there, right? And it's not taxable.
And I think, as Simpreet said, age 18 is when you can open up a TFSA,
Yes.
right?
Yeah.
Can you take out money from a TFSA whenever you want?
Yes.
Okay. So that might be then a little bit different than, Barry, what is an RRSP?
Yeah, so RRSP, Registered Retirement Savings Plan, the whole idea is about income deferral. So saving money today for a time where you'll have less money being in retirement. Target retirement age traditionally is 65. So we start saving money as early as we can and as often as we can. And what's the benefit associated with the RRSP is that the money that you contribute to the RSP, you get to take away from your taxable income. So if I make $50,000 a year and I put $5,000 into an RSP, the government perceives it as if I made $45,000, and that can attribute to a tax return. The benefit being that as time goes by and you continue to save, you take benefit of investment growth, investment compounding. The growth within those plans, RRSP specifically, is tax deferred till when it's actually taken out of the account. So the idea being that you'd save money now for a time period of when you need it later on, and you'll be in a lower tax bracket at that later on period, and have to pay less taxes on your money as it's grown tax deferred over the years.
Okay. And you're saying we would be at a lower tax bracket at that point because the assumption is we're retired or retiring.
Yep.
So we're not earning money or the salary that we used to be maybe at the peak of our income. So we would be taxed less when we actually do pull it out.
Yeah, absolutely. So the whole idea is just really, you don't have an income any longer in the same capacity as it was earned before. Maybe your earning capacity is a little bit more limited than it was in your working years, and now's the time for you to utilize that money that you've saved.
Okay. There are opportunities, though, to withdraw from an RSP before retirement, right?
Yes.
I'm speaking personally. I tapped into my RSP when we bought our house, right? So it's house, mortgage, and additional education? Is that right?
So yeah, so lifelong learning, additional education is one of the privileges where there's certain prerequisites and requirements in terms of accessing money for education. And then, yeah, what you're speaking to is the first-time homebuyers withdrawal. And there's certainly a great benefit towards that, and lots of information available online as well.
And the way I understood it, the reason why there's only certain reasons why, or that you can take stuff out without being like heavily taxed, is because they want to put it in, they want to put systems in place for you not to take money out so that it is there when you retire. And maybe the government doesn't have to give you as much through the pension because you've been able to save properly for it, right?
Yeah, and I think the more that you're able to, accumulate and grow on your own, the better position you can put yourself in for the future as well.
That makes sense. Okay, Simpreet, our last acronym maybe of the day, aGIC. What is it?
So a GIC is a guaranteed investment certificate. So Barry and Kevin both went over what a tax-free savings account and RRSP, registered retirement savings plans, are. So a GIC is basically a form of investing within these accounts. So it's not necessarily a separate account. So you can have a GIC, let's say, in a tax-free savings account, or in an RRSP account, or even in a non-registered savings account. So just a regular savings account. And so when you go into, let's say, a branch or a bank and you want to purchase a GIC, you're essentially putting away a certain amount of money. So if I have, let's say, $1,000 or $5,000 GIC, it's $5,000 at whatever rate is available at that time, and it can come in various different terms. So you can have a 1-year GIC, a 2-year GIC, you can have a 9-month GIC. They're various terms, and each term has a percentage allocated to it, and that percentage is the interest you would earn. So let's say I am, and this is just for argument's sake, the rates are not as great as what I'm mentioning, but let's say you lock in $5,000 into a 5-year GIC at 3%. You're essentially guaranteeing yourself that interest for that 5-year term. And it's compounded, so it just continues to grow, and that's essentially it's guaranteed, so it's 100% principal protected, which means there's no risk of losing your money because it's guaranteed.
Okay, yeah, that makes lots. So there's lots of different options. One question that did come in, and I think it's an important thing to note because again, as a high school student, I didn't know all this stuff. The TFSAs and RRSPs and GICs, all this fun stuff we're talking about today. It's not like Scotiabank invented these, right? So
Exactly.
this is a system that has been set up, I guess, by the federal government and will be consistent from financial institution, like from bank to bank. Of course, rates and such may differ, but these types of opportunities are available at lots of different institutions, right?
Yes.
Yeah. Okay. So one of the questions that we did get about institutions is, what's a credit union and how is that different than a bank like Scotiabank? Kevin, I think it's your turn. Can you take that one?
So a credit union, generally speaking, it's a smaller institution. They're usually regional or provincial in nature. They can either be a collective of similarly aligned individuals like civil servants or government employees or something like that. And generally speaking, the ownership structure is different from a bank. Banks are publicly traded companies. They're large corporations. Credit unions tend to be community owned, or they're owned actually by the members. So it's just for us, it's a bit of a different ownership structure. There's certainly different capabilities, given that their range is a bit smaller. They're not as, usually it's not a national reach. So they'll often have to partner with one another if they have clients that want to do some more complex things. And also the range of products that they offer might be slightly different than what we're capable of doing at the national level.
Makes sense. So it sounds like it's more community driven. So for students, when you're assessing what options are available to you, the big thing is to think about your goals and to work with the institution that's going to best be able to help you get towards your goals. So we had a follow up with the GIC. So question is, if I invest in a GIC, I don't need to worry about losing money and I can keep investing?
Correct. It's one of our principal guaranteed investment vehicles.
So I think maybe a way that I understand it is it may be a lower percent return than other options, other riskier options. The riskier options may give you a higher return, but they may also give you a lesser return or even lose you money, right?
Exactly.
So, I think it's an interesting thing for students, and there may be a tool through Scotiabank to do it even as an exercise, is trying to figure out kind of what your risk tolerance is, right? So when you're setting up your TFSA or whatever investment options, a lot of these institutions now have these kind of online quizzes, and they ask you questions about, are you the type of person who would worry a lot if there was a big dip, or are you the type of person who is just going to set it and forget it? And based on all these types of questions, and again, your goals, they're going to recommend the types of opportunities, which may be a mix. And actually it is going to be a mix. So Barry, what does a diversified portfolio mean? I keep hearing that word all the time.
Yeah, it's a great question. Diversified portfolios are really just about balance. And you spoke to risk tolerance and how you feel about maybe necessity to make money or the potential of losing money. And it makes people feel different feelings. Some people are okay with different levels of risk and money going up and down, and some people can't tolerate it at all. So when we talk about diversity, it's about trying to find balance in the appropriate mix to make sure that we stay within your comfort zone and you really have the benefit of seeing your money grow in the way that you want to see it grow. And I think that's huge. And you spoke a little bit before about, establishing relationships with the bank and understanding the guidance and the feedback that you're receiving from that person that you're in front of. And I think, when we talk about diversity and we talk about making sure that we have appropriate mix, it's all based on assessment of what customers' goals are. And so being upfront and honest about what your goals are, having clearly defined objectives, they all create a scenario where we're able to advise to a diversified mix of investments and balance.
The way I internalize all that, for the young people listening, diversified portfolio in my mind is that you don't want to put all your eggs in one basket, because you may drop the basket and all the eggs are going to crack, and all those eggs were your retirement money, right? So you want to put them into different baskets so that even if some do drop, the other ones will get you to where you need to go.
Yeah, and the one analogy I actually try and use is, if you think about it maybe like a sports team, right? You've got a certain percent, like you've got your portfolio. Some of your sports team is, like your job is to go score goals, right? And you're looking to employ this percentage of portfolio to gain return. Some of your portfolio is there to defend what you have and preserve your principal. right? So it's different parts of your portfolio have different purposes, and you would structure that portfolio and invest it in certain vehicles to achieve those goals. All towards, your end goal may stay the same, right? But you're partitioning off your portfolio to kind of, achieve it in a way that helps you sleep at night.
I haven't heard that one before, Kevin. I like that.
It's a great analogy.
Yeah, I think we're all going to borrow it. Simpreet, you talked about working throughout your undergraduate studies. So refresh us, what did you go to school for? It was a men's clothing store. And then talk about kind of how much were you working? Like, was it sustainable? Any advice for young people? That kind of thing.
So, I mean, ideally when you start university, you're hoping that your parents have put aside, like have started an RRSP plan for you, right? A registered education savings plan. So in our case, I'm one of 3, right? So we all had RRSPs established for ourselves, but I made the decision to, want to go to university in Waterloo. I was in business and economics. So living on campus isn't cheap, and even living off campus in Waterloo wasn't cheap either. So, yes, my parents helped out with university and whatnot, but you obviously want to do your part as well. And I really enjoyed working at the men's clothing store. My coworkers were phenomenal. So I was fortunate that they were willing to keep me on board when it came to working throughout the school year. So back then there wasn't Go Bus that went all the way to Waterloo. There was either the Via Rail or we kind of would get along with people that kind of lived in the same area and just hitch a ride back to Mississauga or back to Waterloo. So I used to work Fridays, Saturdays, and Sundays all throughout the university, all throughout my semesters in fall and winter, and then full time in the summers. And it helped me a lot. It helped me, really kind of pay my tuition and pay for rent as well, and just obviously give me some pocket money as well in university. Again, that mindset of, oh my gosh, I can't borrow money, because then if I take OSAP, it's graduating with OSAP as well, right? And factoring that into how am I going to pay this off? And it went well. The program was fantastic at Laurier, and working alongside kind of really helped me with money management and time management. But in my final year, it was too crazy of a workload, and schooling just gets tougher and tougher, right, as you progress into the final years. Mm-hmm. So in my final year, I said, you know what, I think it's probably the wisest decision for me to take OSAP for my final year and not work, and so I can dedicate my full time to finishing off school and finishing it off well. Mm-hmm. Because finishing off with a strong GPA is also important if you're looking at, let's say, MBA programs and other programs afterwards.
Okay, no, that's super helpful. So if you're working on the weekends, what do you think? That's maybe 10, 20 hours the most a week?
I used to, I mean, Fridays, I would try to not work on a Friday night, but, because generally stores are open till 9 p.m. So I would try to do a 10 a.m. to 9 p.m. shift or whatever it may be, and just try to break it up in on the weekends. And Sundays I would work until 5, catch my, Via Rail back to Waterloo, and that was it.
And you mentioned something important there, Simpreet, about having some money for pocket expenses, right? Mm-hmm. I'm biased, but I think there's so many amazing reasons to get a part-time job, whatever level of education you're at. Not only is it going to put a little bit of money in your pocket, but you're going to get the experience from working. And sure, maybe Simpreet didn't want to work at a men's clothing store for the rest of her life, but there's so many of the 21st century skills, these core competencies that we love to talk about, that you don't really get to practice until you're out there in the real world and working somewhere. So if you can get a job, it's not just for the money in your pocket, it's for the resume too at the end of the day. A lot of the times when you're talking to adults, they'll tell you, don't worry too much about the program, right? You're gonna change jobs, you're gonna change careers. It's more important. A big part of post-secondary is about the experience and being able to have these opportunities to develop some of these 21st century skills, right? So one of my favorite, because we collected a few of those, when I was 18, here's what I wish I knew about money. And one of your colleagues from Scotiabank said, I wish I knew that, yes, it was important to save for the future, but also to save for today. You're only going to be young once. Not going to spend a lot of time in post-secondary when you look at it. So it's important to be able to enjoy those experiences, and working a little bit, if you can often provide those opportunities for you. So guys, I made a bunch of financial mistakes. So I had to take OSAP, and for everyone who's not in Ontario, OSAP is the Ontario Student Loan Program. I can't remember what it stands for. Single mother, growing up. So I actually got a decent bit of OSAP, to the point where it paid for rent, it paid for tuition. Wasn't a lot of money left over after that. So I also worked throughout post-secondary when it was manageable. but I had a decent bit of OSAP debt at the end of my 4 years. So like to the tune of close to 40K I was coming out of school with. And so, you know, it hangs over your head and, you know, what am I going to do with this? And for a long time, I told myself this myth or this fallacy that I'm going to get a job, I'm going to make money, I'm going to be really diligent about saving that money, and I'm just going to invest it. And I'm going to make more in those returns at a higher percent than the OSAP fee, the percentage that I had to pay back in interest. Kevin, is that a good idea or not?
It's an ambitious idea.
Yeah.
I don't fault the underlying reasoning behind it, but the one thing I would say is if it was that easy, then everybody would be doing it, right? I think it's a noble idea. I think that if you put the time and research and effort into it, you still, like, if you knew everything you knew about the market to get to that point, you wouldn't be sitting in the chair that you are right now, right? So while it's a great idea, I think you need to be balanced in your approach. I would certainly encourage getting invested, getting into the market, getting yourself conversant and knowledgeable about how to invest at an early stage. But you need to balance that off with, okay, well, at minimum, when would I like to get this debt paid off so I can do other things? Right? And you have to have a plan. Okay, so maybe, you know, out of, you know, my paychecks, you know, $1,000, you know, $100 goes towards paying the debt off, right? And then I take another $100 and put it towards investing, right? And that way you've got a two-pronged approach where you're able to, you know, learn, and maybe you can invest and get some return to help pay you off the debt faster. But even if you don't, okay, at least, you know what, I'm $100 down every month. So $1,200 is, you know, paid off every year.
Yes, that's great advice. That was the answer I was looking for. I mean, it was a bad idea, and in my mind, like, it didn't work out that way. It was very ambitious. You know, it took about a year or two of me just paying like the minimum interest payments for me to realize that I wasn't the investing guru that I thought I was. That yes, if it was that easy, why isn't everyone just doing this? And then as you start to get a bit older, yeah, you start to think about house, you start to think about a new car, you start to think about these big life things that having $40,000 of debt is not going to help your case for. So I quickly changed strategies, and you know, everything I read online as well said, you know, you want to tackle your personal debt before trying to take on the next big things. And you know, for all the students watching, it's really fun to hear like the stories about AMC and GameStop and Dogecoin, right? Like, it's fun. I enjoy it too, but those are the exceptions, not the rule. And it can be very risky to have the mindset that I had, thinking that, I'm just going to make 50K next year in investments. And you gotta look at your goals, and you got to do what makes the most sense. So speaking of goals, I'm 16-year-old listening to this. I don't have a bank account yet. Barry, what's the best kind of bank account that a first-time bank account opener should open?
Yeah, you know, great question. I think when you think about a 16-year-old, there's a multitude of options that are probably available across many different banks, but I think you're in this unique place where you can benefit from no fee options, student programs, or under 19 programs. You know, what we call our account is the Getting There savings account, which is actually in effect to the age of 19 and provides free banking. And it's an opportunity to really just kind of cultivate an idea of how to manage money, how to spend, how to really manage your own expenses, and get an idea of how to best utilize your accounts. So I would say that, you know, taking some of those options that are available, whether they're student options or youth options, and coupling those with the savings plan to try and see, you know, how disciplined you can be in your approach and how much money you can put aside for yourself is probably one of the best ways to go about it.
That's a great answer. And you know what, one of the things I haven't heard talked about today, and Simpreet, I'll pass it to you. You know, we've talked, I think, with your education, you talked about RRSP, so registered education savings plan, that are usually set up by parents, right? We talked about OSAP, you know, just saving as you're working throughout high school. What's a student line of credit? Like, what's that?
So a student line of credit is essentially a line of credit, but it's meant for students to supplement, you know, paying for education. So in some instances, let's say you do qualify for OSAP, and OSAP ranges as well, right? It may not be the same amount for every single person. So depending on whether you have some, you know, additional expenses like rent, or there's certain equipment that you need for the program that you're going into, textbooks, all that jazz, then a student line of credit, although it's not a replica of OSAP, it allows you to have, you know, a loan that you're given by the bank that you would pay back after you graduate, that can kind of bridge that gap between starting your education journey and financing it.
How it's different than a credit card in terms of it's much lower
An
interest rate?
interest.
Right.
Yes. It's a fairly lower interest rate, and the payback structure is very different from that of a credit card. So if you are, let's say you have additional expenses, let's say for university that you need to bridge in the form of a student line of credit, use a student line of credit. Don't use a credit card, even if you're pre-approved. It's not the right thing to do, just because of the difference in interest rates sometimes tends to be very significant.
Credit, I think, sometimes throws people off because it's in credit card. So I almost assume that I'm building my credit by using my credit card and paying off credit card. But with student line of credit, using that and paying it off also helps to build my credit, right? The banks or the institutions are looking at every kind of little moving piece you have and your ability to pay it back. Is that the idea?
Correct.
Okay.
And I think one thing to keep in mind for anyone who's taken that grade 11 or grade 12 accounting course, debits and credits are flipped from the perspective of the bank, right? That was my first point to the bank moment. Debit, what? So debit and credit, we use it's the reverse of the accounting term, just as we go through this.
Yeah, I haven't really thought about that. That is interesting. So guys, I'm a grade 10 student listening to this right now. I don't know anything about, this is my first introduction to financial literacy, taxes, crypto, everything. Where do you recommend a young person goes to learn about this kind of stuff? I know that there's an amazing organization, Junior Achievement, that does a lot of work throughout schools across Canada to bring professionals into the classroom, but that's not always consistent. Like, do you have an idea of where a young person might go to continue learning about this even after the webinar?
I think if if you're in a position where, let's say you are looking to start your journey and to go open up a bank account with any institution, as Barry said, a lot of them have student programs that are free of charge, right? There's no monthly fees associated. And don't be afraid to ask questions. That's what we're here to do. That's essentially our job. So there's no such thing as a stupid question. If you're learning and trying to understand the concept of savings and how to set up those automatic savings that Damien spoke about, now's the opportunity when let's say you go to open an account to understand all that information. And the more questions you have, and if you come to your appointment prepared, they can help you with that, whether it's a teller on the front line, or perhaps if you have a question that they don't have the answers to, then they'll refer you to a financial advisor who can kind of go over all the questions that you might have to make sure that you can make a sound decision for yourself.
Yes, I've only come to learn that asking questions is the best way to get answers. I mean,
absolutely.
Do your research online as well, guys. Just be critical thinkers. Like, be very cognizant of what blog or what video you're watching, and talk about with your peers, talk about your teachers. Do your research and then go to the financial institution, then go to Scotia, then go to the bank and say, hey, I found all this stuff. Is it legit, right? We talked, a lot about these TFSAs and things that you have to be 18 to open. Are there any investment opportunities through a financial institution that are available to younger people under the age of 18? Let's do Kevin for this one.
So certainly on certain accounts, like a brokerage account, stuff like that, you wouldn't be able to open that until you turn 18. But you can certainly, what we recommend, if you're interested in that, sometimes, talk to your parents, right? And if you want to start investing money through them or with their guidance and with their supervision, that's something that we see a lot of my clients are doing right now. Like, they want their children to be knowledgeable and aware of what's in the market. And the earlier you get involved, the earlier you try and touch all these points, the better it is for you. So typically that's the solution that we would have in place for this. But if you want to start out just with a savings account, that's certainly something you can have at an earlier age.
Guys, I want to be cognizant of everyone's time. You all have branches to run as well. So let's finish it up with just kind of a rapid fire. Barry, if I watch this, we threw a lot of acronyms and terms and information at students today. What's one thing you would want a young person to leave with today to put them in the best possible position to make more informed financial decisions?
Yeah, I think that, looking back, I think it's important to understand what your goals are, try to assemble some idea of what you want to achieve, do your research, ask questions. I think the whole concept of finances and dealing with an institution, it can be really daunting and it can be a little bit intimidating. And so the sooner you start, the more comfortable you become. The more comfortable you become, the more informed you are. And I think by coupling all those things together, it really caters to a great gateway to the future. And so I wish that I had stepped into a bank sooner and started asking some of the right questions, or even some of the wrong questions, just to get some answers and really kind of define, my own perspective. So the sooner you can get started, the better. And I think that's a great takeaway.
Okay. Simpreet, I know, so I'm about to turn 18. and I know that I want to buy a house by the time I'm 30. And I know from your story that it's a good idea to start building my credit early. What's your top takeaway for someone listening to this to build their credit early from a young age?
So definitely take advantage of a lot of the student programs that banks offer where you can get a pre-approved credit card without requiring, I mean, it's good to have, right? Get a credit card when you have an income stream coming in. When you have a part-time job, it makes it easier for you to know that if I use, let's say, $40 on my credit card, when I get paid, I can pay that $40 back, and generally, like if you're, let's say, buying a McDonald's Happy Meal or whatever, a meal, right, from anywhere, if you know, okay, I'm going to spend the $3 from my debit account anyways, pay it, like spend it on your credit card and then make the transfer, let's say that evening or like, in a week or so just to make sure that you haven't acquired any sort of interest. But act like it's your money, right? Act like it's your money that you're spending, because then you'll be more inclined to make sure that you're paying it off sooner. And just like you said, just educate yourself on the things that, comprise of making sure your credit is in good standing. There's a lot of tools out there that will tell you, what to do and what not to do when it comes to credit. So make sure you take the time to educate yourself and have a solid understanding as to what your comfort level is when it comes to credit. And that's essentially it.
Build the habits early, right?
Build the habits early,
yeah. The good habits, yeah.
The good habits.
I should mention as well, guys, we haven't mentioned it yet, but for anyone who hasn't seen them, for all the grade 12s here, Scotiabank put up a few different scholarships through My Blueprint. So if you haven't already applied for those scholarships, there's a few different ones depending on what region of the country you're in. Take advantage of those because the deadline is coming up soon. And Kevin, let's wrap up with you. I think the question that everybody in this group wants to know, what car did you buy when you had some money to buy a car?
It was a used silver BMW 3 Series.
Okay, I bet it was pretty sweet though when you first got it, right?
It was, and then it started to break down. And yeah, a depreciating asset it's something that's expected to lose money over time. So a car is a fantastic example of it. You drive off the lot, you've already probably lost 20% of the value. So no chance of making money on something like that. Yeah. So the one thing just before we go, I wanted to add is the fact that everyone's on this call already, and the fact that you guys are asking the questions that you're asking so far ahead of where I was when I was your age. And the fact that you're doing that tells me you're already on the right track. So kudos to you for doing this. Kudos for you taking an active interest in this. Don't stress out over this stuff, because the fact that you're already taking an active interest in this, you're taking a controlling role in managing your finances going forward, means you're on the right track. So kudos to all of you for doing this.
Yeah, I appreciate that, Kevin. Yeah, and kudos to the three of you for making time to share your wisdom and your knowledge with these young people. You're absolutely right. I mean, everyone's going to make a few mistakes here and there, but the fact that they're taking the time to learn about how to avoid those mistakes, is just that many more to avoid, right? So guys, I can't thank you enough for taking the time. For everyone watching, I really hope you enjoyed, really hope you learned some new information. Like Kevin, Simpreet, and Barry all mentioned, these are all very approachable people, right? You don't have to necessarily go and find out their branch, but there's people that are willing to talk to at all these different institutions. There's Gianna Camasoli, episode 14 of the Competencies Without a Classroom podcast, who has a lot of great information to share about what opportunities are available to young people looking to get involved in working with financial institutions. So take it all, enjoy it. You will make mistakes, but you're going to have a great time learning along the way. And have a fantastic day, everybody.